15 years, investors had one giant safety net, the Fed. Every time markets broke, the Federal Reserve stepped in with lower rates, more liquidity, and more money printing. Now that era might be ending because the new Fed chair, Kevin Warsh, wants a smaller Fed, less market intervention, and far less support for financial assets than prior Federal Reserve regimens. If he succeeds, the investing playbook that has worked really well since 2009 might not be as effective moving forward, and most investors are completely unprepared for that shift. This is not really about the next rate cut. It's about regimen change. That shift matters more than any single interest rate decision. The crutch, otherwise known as the Fed cut, might be going away. And so in this video, we're going to cover why that is such a big deal. We're going to talk about what changes are coming, what stays the same, and the one mistake that most investors are likely to make if they don't factor this into their portfolio decisions. Okay, for 15 years, the Fed trained investors to lean on mountains of cheap money and constant support in financial markets. That taught investors to always buy the dip. Markets moved on Fed guidance and signals as much as on real fundamentals. Pricing got distorted across almost every asset class due to all that, quote, free money and quantitative easing. Now, Warsh wants to end the free money experiment. He has called for regimen change at the Fed. He wants the central bank to be smaller, quieter, and less of the market manipulate. He wants fewer artificial tailwinds for growth at all cost assets. In other words, this is a shift away from liquidity-driven markets and toward cash flow-driven returns.